Thanks for clicking. An increase in the money supply exacerbated Canada's inflation rate. This according to 2,000 years of history and a new report coming from TD Bank.
Are you serious?
You knew. And we've talked before on this channel about how the price increases that we've seen were completely predictable during the pandemic, as the money supply was increasing at its fastest rate in 30 years, with the Bank of Canada injecting over $400 billion vis-a-vis quantitative easing, and the much now discredited MMT saying that we can print money forever without consequences.
You were my guy.
But the TD article goes even further, demonstrating why we saw inflation in 2022, but not in the aftermath of 2008, when the money supply was also greatly increased. Further, the article argues that as the money supply is now decreasing, we can also expect to see more disinflation, price increases slowing down. So what I want to do today is go over TD's report, taking a look at the increases in the money supply, then discuss the differences between the aftermath of 2008 and 2022, and then discuss how this shrinking money supply will put downward pressure on Canada's inflation rate. The Canadian Real Estate Association, the CREA, is set to release its national sales data for the month of August any day now, and we'll obviously have an update out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into TD's report. Onto the report. First up, a brief bit of theory, as TD notes that the linkage between the money supply and inflation has stood the test of time. And we've talked about this before on this channel. When the money supply increases without a corresponding increase in production, when we have too much money chasing too few goods, consumers bid up prices. The Federal Reserve actually has a video on this right on their website.
When people have money, they tend to spend it. And the more money people have, the more they tend to spend. As a result, if the money supply increases too quickly, the supply of goods and services might not keep up with what people want to buy. So prices are pushed higher as people compete to buy goods and services.
Well, nobody talked to me.
And we've seen this over and over again throughout history, from the Weimar Republic to the Great Recoinage Act in England in the 17th century to the clipped Roman coins. And, more recently, during the pandemic, when the Bank of Canada lowered interest rates to near zero and engaged in a massive round of quantitative easing, buying up over $400 billion worth of government bonds. As a result of these pandemic policies, Canada's money supply increased substantially, with M1+, which measures all of the money held outside of the banks, as well as deposits and non-checkable deposits, what you and I would consider money, the money that we use, increasing 50% during the pandemic. Further, if we look at M2, which takes everything from M1+ and adds in mutual funds and personal savings bonds, that grew closer to 20%. And TD notes that after we saw these major increases in the money supply in both M1+ and M2+, we saw a major growth in inflation. But even TD notes that in the aftermath of 2008, the money supply also increased, but we didn't see a major increase in inflation. So why the difference? If we look back, we can see that there was a major increase in the money supply in the aftermath of the 2008 global financial crisis. However, TD notes that the Bank of Canada did not engage in quantitative easing back in 2008 and 2009. It didn't have any large-scale Canadian government bond purchases. While the bank back then did purchase some securities as a means of injecting liquidity into various sectors of the financial system, they also sold assets. They also sold off government treasuries. So back in 2008, you did have the Bank of Canada injecting some liquidity into the market, injecting cash into various parts of the financial system, but you also had them pushing it out. When the Bank of Canada sells off an asset, when it sells off government bonds, that takes money out of the economy. The money is out floating around in the economy and then gets transferred to the Bank of Canada, where it's no longer in circulation. It's no longer out there bidding up prices.
I need that money, that's all we got!
In contrast, during the pandemic, the BOC bought $440 billion worth of securities, buying up government debt with printed money, created money, from the banks, which allowed banks to increase their lending by $450 billion. As a result, we do have an increase in the money supply in 2008, but not nearly as much as we saw in 2020 and 2021. Further, in 08 and 09, while we did see the money supply increase substantially, not as much as 2020 and 2021, but still substantially, we didn't have shutdowns. And that's the other key part of the equation. If we have an increase in the money supply, but production is also increasing, we shouldn't see as much inflation. There isn't as few of goods and too much money chasing it. However, with the shutdowns, says TD, This led to a much larger imbalance between the availability of funds to purchase goods and services and the economy's ability to produce them. So in 2020 and 2021, unlike 08 and 09, you had the central bank printing money, injecting billions, hundreds of billions of dollars into the economy when the economy wasn't producing anything. You put money into people's pockets and there's nothing to buy. What is to buy, the price of what is available, is going to increase as consumers bid up prices. Further, although this is left out of TD's report, I also think it's worth noting that during 08 and 09, the Federal Reserve did engage in a large-scale quantitative easing program. However, a lot of that money didn't make it into the real economy. A lot of that money was just hoarded by the banks. Contrast that with the massive QE, the massive asset purchases coming from the Fed in 2020 and 2021, and Canada's largest trading partner also saw a major increase in its money supply, most of which is all floating around. So, according to this report, during the pandemic, we had the Bank of Canada massively increasing the money supply. Unlike 08, that money supply made it out into the real economy, made it out to consumers who were able to bid up prices, and that led to the major inflation that we've been seeing over the past 2 years. But so what? Why does all this matter? First, recognizing the causal linkage between the money supply and inflation is important so that A, if it ever happens again, experts will be much better apt to predict the impending inflation. If you just put up your hands and say, well, the bank said low until 2023, you're not really learning anything which will help you in the future.
But so what?
And B, and almost more importantly, is that the money supply is coming down and inflation is following. If we look at the current monetary aggregates, we can see that the money supply is actually shrinking, with M1 Plus down 7% as of July, and M2 growing much slower than previous patterns. And we know that money is leaving the economy at a rapid pace, with mortgage renewals coming in much higher every time the Bank of Canada raises rates, more payments from variable rate holders going to the banks. That's all money leaving the economy. And that money isn't being put back into the economy, especially with fixed rates sitting around 6%. So, all things being equal, a shrinking money supply should put downward pressure on Canada's inflation data. Not now, as we saw in 2021-2022. Inflation works with a lag. The link between the money supply and inflation works with a lag. It does take a little bit. All things being equal, with this kind of money leaving the economy, we should see more downward pressure be put on inflation. We will see more disinflationary pressures as time goes on. Now, with all of that said, once inflation is kickstarted, it is very difficult to get it back down to where it was, as there are still a number of pressures being put on the inflation rate, including wage growth, inflated real estate prices, oil prices, exogenous shocks, etc. With that said, though, by definition, a decrease in the money supply should put more pressure downward on our inflation rate. So, while Canadians wait for inflation to come down, even though we're probably going to see it went up at the next print, while Canadians wait for price growth to slow, we do have a decrease in the money supply working for us. How long all of this will take remains to be seen, but we will obviously continue to track Canada's economy and its slowing price growth on this channel. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.